we're so caught up in what the interest rate is because we feel like the interest rate dictates how much interest we pay, which is not necessarily true. That 3% equates to about a 40 or 50% in interest over a 30-year period. But we are hung up on the payment because the payment is what we can afford on a monthly basis inside of our budget. Having said that, you could alternatively finance it on a line of credit. Now, could you get 3% on a line of credit? Yeah, I mean, on a promo rate, there are some that are out there at 1.99, 2.99, 3.99, whatever the promo rates that community banks and credit unions are offering. But instead of focusing on the interest rate, we're going to focus on the total interest that you're going to be paying. So if you finance it on a line of credit and then use the line of credit as your bank account. So instead of depositing money into a checking and savings account, you're now depositing your money into your line of credit because it's a different animal than a mortgage is. Money can move in and out freely 24/7. So we're bypassing the need for a checking and savings account where money's just sitting in there earning negative 1,841% return because the rate of return you get on a checking and savings account does not keep up with inflation. Historical inflation is 3.3%. Checking account right now is 0.07%, national average. I think the savings account rate is about 0.35%, somewhere around that. So long story short, instead of just storing money in a checking and savings account where it's not keeping up with the cost of inflation, we don't need a bank account to begin with. We could actually use the line of credit as our bank account, dump all of our cash flow into it, and let's say even if you were at a 6% interest rate on a home equity line of credit on another home, your total interest percentage is still going to be significantly less than that 3% on the other home. So we just have to look at it through a different perspective. Am I really focused on what the monthly payment is and what the interest rate is? Or are we focused on how much we're actually going to be paying for this home that we can afford? So if it's the latter, then we need to look at alternative ways of financing, more strategic ways of financing, which I would obviously be an advocate for lines of credit. So get into that other home, and that other home can still be significantly cheaper than your existing home, so you don't have to feel stuck, is what I'm getting at. You just don't think so linear. Got a mortgage over here, new property means mortgage over here. It doesn't have to be a mortgage. It could be a line of credit, which means it could be cheaper debt if you understand how to borrow correctly.